Greetings, everyone, and welcome to Cutting Through the Noise, our monthly investment webcast. I'm Samantha Geyer, Marketing and Communications Manager at SignatureFD, and I'll be today's moderator. Before we dive into the presentation, let me tell you a little bit about Tony and our firm. Tony's a partner and Chief Investment Officer at SignatureFD. He chairs our investment committee and represents the firm at various industry events. Tony's a contributor on numerous broadcasts, including NASDAQ Trade Talks and TD Ameritrade Network, and his commentary has been featured in articles from the Wall Street Journal, Barron's, the Financial Times, the Bond Buyer, CNN Business, and other prominent industry publications. SignatureFD is a financial advising firm headquartered in Atlanta, Georgia. We believe in helping our clients achieve wealth beyond money. We empower our clients to use all elements of their wealth to create a financial design that helps them grow, protect, give, and live their wealth to the fullest. It's what we call net worthwhile. With that, I'll turn it over to Tony to get us started.
All right, thanks a lot, Samantha. So we're going to do things just a little bit different today. Our next webcast, just so everybody's aware of timing on these things, is going to be in about mid-December. So I wanted to take this time to give a pretty comprehensive overview of where the economy stands here in Q4 and as we think about next year. Because of the comprehensive nature of this discussion, we'll probably run a little bit longer than we usually do on these, and hopefully that's okay. But here's what we have on the agenda is we want to talk about where consensus was heading into this year. And then we're going to touch on the status of the pandemic savings in the labor markets. And though timing the markets and the economy is really a difficult endeavor, we're going to touch on what the conditions may look like when we are at risk of that next recession. Okay, so starting with this, heading into the year, consensus economist forecasts were for a 2023 recession. There were really good reasons to expect that. Many of the leading economic indicators that economists tracked suggested that we would, in fact, have been in a recession by now. So here, what I'm showing is the Conference Board's index of leading economic indicators, and that's in orange in the bottom clip. Now, notice that it's been in a zone that's consistent with recession, and that happened early on in 2022 and all the way through this year thus far. So the leading indicators themselves have been saying that this economy should have recessed by now, or we should be in recession. Now, what's in those leading economic indicators? Well, I've got it listed out here on the right. It includes job data, especially in the manufacturing sector. We'll talk about that a little bit because that's important. Building permits, stock prices themselves, the yield curve, and consumer expectations. So what we're going to do is we're going to take a look at each of these components and discuss what makes it a little bit different in this cycle. So starting with consumer sentiment, this has been what some are referring to as kind of a bad vibes expansion. So consumer sentiment has been pretty bleak for an expansion that has more or less been beating expectations this year. So here in this chart in blue, I'm showing consumer sentiment. And in orange, we're showing this so-called misery index. And that's just the combination of the unemployment rate and the inflation rate. So unemployment spiked in the pandemic, and after jobs came back, we got inflation. Inflation was a problem. So consumer confidence is directly related to their inflation-adjusted income. So it makes sense that confidence had been low. However, throughout this year, it's been rebounding, and that's something that we were writing about at the end of last year, was our expectation that consumer confidence was very poor in 2022 and would start to come back in 2023. Now, the stock market itself is another leading economic indicator. And we had a bear market in 2022. Now, this chart here plots the economy in blue in the top clip and the stock market in red in the bottom clip. Now, this simple indicator gives a positive signal on the economy when stocks are rallying, and it gives a negative signal for the economy when stocks are contracting. Now, a few things to note. First, the market is usually right. 77% of the time, the stock market has given us an accurate signal on the economy. But I would note that it's not always right of them, either right on cue or in advance, and it missed 2 recessions altogether. Then there were also 7 false alarms. So it's not abnormal to get a major correction in the market or even a bear market without a recession. So here what we're showing is a stylized chart. It's showing the traditional stock market cycle in the top clip and the economic and earnings cycle in the bottom clip. Now, as mentioned before, stocks almost always decline under recessionary conditions. Then what happens is the market experiences a strong bounce as the economy begins its early stage snapback in activity. But it's not abnormal to get a follow-up bear market as the economy downshifts from quick snapback to a more sustainable trajectory. Now, we think that's exactly what happened in 2022. And eventually, what happens from a market pattern perspective is the market settles back into a slower, more sustainable uptrend until you roll into the next recession. So that's where we think we are today. We think we're in that slower bull market stage of the market cycle, and we'll likely remain there until more recessionary pressure builds. Now, there was a time when the economy went into a double dip recession, and I think that's the fear today. Are we going to get a recession soon? And that time was in 1980. Now, there's a big similarity with 1980 and today, and that is that the Fed is fighting an inflation impulse. And we obviously cannot rule out another bout of inflation, especially if geopolitical risks send energy or food prices meaningfully higher. And in fact, the inflation impulses of the 1910s, 1940s, and 1970s, we did in fact get a second wave of inflation. But our current base case is that inflation will begin to improve, potentially rapidly after January. So this chart here is showing the potential paths for inflation based on different monthly changes in prices. The brown line would be what would occur if the monthly change in inflation were 0.6%. So that's quite a high reading in monthly inflation. Now, the silver line is what would happen if monthly changes were 0.5%. Now, we don't think either of those is likely for a few reasons. Well, first, core goods and services inflation remains very contained, remains very low. And second, shelter inflation has a long lag, and it's finally beginning to soften. So the monthly inflation prints we think are going to come in lower than 0.4%. And in fact, if you look at the different trajectories for inflation, inflation prints of 0 to 0.3% each month seem manageable from a policy perspective. But we should remember that it isn't inflation itself that causes a recession. More so, it's the policy response to that inflation. So here we're showing the real Fed funds rate in red in the lower clip. That is just the rate that the Fed is charging minus inflation. So we can see that because the Fed was historically easy going into this rate hiking cycle, they've just now gotten back to the historical average real rate. In other words, monetary policy hasn't even really been that tight this year. Now note that the real rate almost reached 10% ahead of the 1980 recession. Now, another factor that economists generally missed heading into this year was the fiscal thrust that we've seen. Now, here in this chart, we're showing an index in orange that combines monetary policy, fiscal policy, and the change in the dollar. Now, you bring those things together, and that kind of gives us a picture of the total policy mix. Now, the blue line, that shows the year-over-year change in that policy mix. Now, you can see that it is shot higher this year, and that is entirely driven by higher government expenditures and lower tax receipts. Now, while the Inflation Reduction Act and the CHIPS Act are set to add to the budget deficit next year, they haven't really been the story this year. Instead, it's been the increased government outlays that have come from huge programs with automatic inflation stabilizers. So this chart here, this shows the changes in Medicare spending year over year in blue and Social Security in red. Now note that Medicare expenditures are up a whopping 21% year over year, and Social Security is up nearly 11%. Then consider that 18% of the population is over the age of 65, and that's a big chunk of individuals that have gotten a sizable Social Security raise. And that's actually quite stimulative for economic activity. Now, outside of Social Security benefits, we've also seen that wages have gone up relative to inflation this year. So this chart brings that all together. In red, it shows the change in real disposable personal income. And that's a calculation that includes both wages and Social Security. Now note that through August, real income was up almost 4.5%, which is higher than the average since 1988. Now in blue, we show inflation-adjusted consumer spending. These two series obviously correlate with each other. So as real income goes up, so does real spending. Now, consumer spending has been a segment of the economy that has really beaten expectations by a long shot this year. Okay, so that's where we've been, but let's spend a little bit of time talking about where we're going. Now, the punchline is that we still think there's enough strength in the labor market and enough pandemic savings to maintain an expansion for the foreseeable future. So let's start with the labor market. This chart here plots the number of job openings relative to the number of unemployed individuals, and that plot is in blue in the top clip and again in orange in the bottom clip. Now the dashed orange line in that top clip, that plots wages. So the ratio of job openings to unemployed individuals hit a pretty crazy high level of 2-to-1 back in 2021. Now that's been receding somewhat, but we're still at 1.5-to-1 in terms of job openings to unemployed individuals. And that is not what we would call a balanced labor market. So we probably need to see more job openings come offline before unemployment actually rises meaningfully. Now, thus far, the loosening of labor conditions has softened wage growth somewhat and resulted in a benign softening of inflation pressure. Now, eventually, the labor market is going to come into balance, but that's where we think that the risk of recession will actually go up. Now, I'm going to go over this graph by telling a quick story about an apple farmer. So say an apple farmer can produce 100 bushels of apples with current labor and equipment, but the public demands 50 bushels of apples. That gives you an aggregate demand curve that may look like 81 right here. Now, say a study comes out and states that apples are pretty good for you and the demand goes from 50 bushels to 80 bushels. Well, the apple farmer still has plenty of capacity to meet that demand. They up their output to 80 bushels, but inflation doesn't really need to go up a whole lot. You may get an aggregate demand curve that looks something like 82 here. Now, say some research comes out that says apples let you live 10 years longer and you get to reduce your exercise to 0, and you still maintain that 10 extra years of life just because you're eating apples. Now the public all of a sudden demands 200 bushels of apples, and the farmer can only produce that 100 bushels, even at full capacity. Now, you may get a huge jump in the demand curve that rockets inflation higher and looks a lot like 83. The farmer begins to onboard a bunch of labor and equipment, and that helps them produce more apples. And at the same time, some research comes out that says the prior benefits are overstated. Apples are good, they're just not an extra 10 years of life good. Now, you may see demand drop a little bit, still over 100 bushels, and the curve drops to something that looks like 84 here. There are now more jobs, more capital, more apples being produced. So everything is getting closer to equilibrium. And eventually the market balances. And the apple farmer can make exactly the same amount of apples that the public demands. Now you go back down to a level that looks like this, a balanced market. Now that seems great, but remember that the apple farmer hired a bunch of folks. They invested in a lot more equipment when demand was 200 bushels. What happens if demand falls below the farmer's capability? That's when they may need to let some employees go. Now we've turned this into a story, but the real world application is that a fully balanced labor market is actually extremely difficult to maintain. And that's not something that we just make up in theory. That's something we've actually observed time and time again. And we've seen it in the real world economy. So here we're showing the unemployment rate all the way back to 1948. Note that the unemployment rate rarely stays at very low levels for long, usually no more than a year or so. It's quite difficult to maintain super low unemployment for extended periods, and that is partially because as unemployment starts to rise, it tends to feed on itself and cause more unemployment. Low unemployment is therefore a pretty unstable condition. So perhaps that is why the stock market has done better when unemployment has been very high rather than when unemployment's been low. Investors know that eventually a demand shock will lead to job loss and the economy will recess. And that's what this chart here shows. When the unemployment rate has been low, stocks have only gone up by 0.8% per annum. Now contrast that to when the unemployment rate has been high, stocks have risen at a nearly 14% per annum rate. So we do think that recession risks will go up once the labor market becomes balanced, but we're certainly not there yet. Now, another big factor supporting consumption is that pandemic savings remain quite high. This chart here estimates that about $1 trillion in extra savings is still available. Now, that's a lot of money given that the size of the US economy is about 27 trillion. Now, finally, let's touch on Fed policy and why higher rates are not denting consumption. Here we're showing a chart of 30-year mortgage rates in dark green. In light green, we're showing the effective mortgage rate on all outstanding mortgages. So yes, new mortgages are nearly 8%, but the effective rate is still under 4%. Consumers termed out their debt, and though we're not showing it here, CFOs got the memo as well. There are actually several large tech companies that have a lot of cash on hand, which is earning more than the interest that they have to pay on their outstanding bonds. Tighter Fed policy will still likely slow activity, but it may take an abnormally long time in this cycle. Now, we need to remember that at the end of the day, this is an economy that is led by consumption, not manufacturing like it once was. There is no better way to illustrate that than to show how services spending has grown through time. So personal consumption expenditures make up 70% of economic activity, and service spending alone makes up nearly half of the economy. That means that expansions are more durable today than when the economy was more manufacturing oriented, and it was driven by swings in the inventory cycle. That's what used to drive the expansion contraction cycle. Nowadays, it tends to be more external shocks to service demand. So to wrap all of this up and keep it very simple, this chart here shows the change in job additions in blue and the change in inflation adjusted spending in orange. Now here's a line at 0%. Note that consumption really only goes negative when the economy is losing jobs. Simply put, when people have a job, they spend money and the economy grows. So the expansion is likely to persist until the job market balances out and there's a subsequent demand shock somewhere. We're not there yet, and calls for 2024 recession still seem premature to us at this point. Okay, so that was a lot of information, and we even threw in a story along the way. I hope you found that valuable. Our next webcast will be more directly investment oriented, where we're going to talk about positioning in 2024. But to sum this up, the economy has greatly outperformed expectations this year. Pandemic savings, a tight labor market, and exceedingly long lags to monetary policy remain factors that are in play as we roll into 2024. Now, eventually, those moats will erode, and the chance of a recession will start to go up, but we just don't think we're there yet. Okay, so that's what we have for you today. Thank you for tuning in, and please don't hesitate with questions, and tune into our webcast in December where we'll go over investment implications heading into the next year.